All right, so here I am at my bookstore, and today I'm going to cover this book here, 101 Economics, the second edition. Things everyone should know about, from securities and derivatives to interest rates and hedge funds and basics of economics, what they all mean for you. And so it's a nice little lengthy book here, 200-something pages, written by Peter Sanders. And on the back of it, it says, from the collapse of housing prices to 1,000-point drops in the stock market, the past 5 years have been full of economic crises. These changes not only affect overall market, they can also drastically influence your personal finances and day-to-day life. In this easy-to-understand guide, Peter explains how the financial systems, as well as most important concept terms and programs in economics. Using simple language, he details how the evolving climate will affect world economics and what kind of shifts you are going to see in your finances as a result. In this updated edition, Center also includes valuable information on the housing market, Obamacare, the Great Recession, and how to take advantage of being as prices begin to rise again. So, written 2014, very applicable to what's going on today. So what we'll do is take a cover-to-cover look inside and see what's going on and see what his 101 things he's just talking about here. So just to thumb through the beginning, dedication, gives credit to his children and whatnot, and his wife for helping him come up with this. And so the contents. Chapter 1 is the basics. And then chapter 2, economy, economics, cycles, dealing with income, consumption, saving and investment, GDP, unemployment, recessions, depressions, business cycle, deleveraging, misery index, consumer confidence, probability, productivity, economic indicators. Chapter 3, money prices and interest rates, money supply, inflation, deflation, stagflation, something most people don't really talk about, interest rates, prime rate, yield curve, risk premium, bond prices, the gold standard. So, interesting to see what we say about that. Then we have banks and central banking in chapter 4, commercial bank, investment bank, central bank, reserve bank, target interest rates, Fed open market operations, fractional reserve banking, interesting, reflation, the paradox of thrift, reserve requirements, loan reserve, tier 1 capital. Chapter 5, government and government programs, U.S. Treasury, federal budget, federal deficits and budgets, Security Acts of 33, 1934, 1940, Security and Exchange Commission, federal deposit insurance, government-sponsored enterprises, tax policy, credit protection, bankruptcy law, entitlements, Social Security, Medicare. So he covers, 101 real topic, real things, retirement plans, unemployment, health insurance. Chapter 6, economic schools and tools, fiscal policy, monetary policy, Keynesian, Chicago Monetary School, Austrian schools, supply side economics, trickle down economics. That's going to be interesting. Reaganomics, behavioral economics, New Deal, planned economic social. Chapter 7, financial markets, derivatives, asset-backed securities, collateralized debt obligations or CDOs. We have credit default swaps, mutual funds, exchange traded funds, hedge funds, private equity, leverage, buyout, and institutional investors, money market, stocks, bonds, commodities, currency market, brokers, electronic funds, wherever it goes on and on. So as you can see, he covers a good chunk of economics. So it's been interesting to see his take on this and how it relates to the Great Recession, and see what his thoughts are on the days ahead. We have currency, foreign debt, balance and trade agreements, whatever. So, all right, so that's basically his 101, ending with the G8 economic summits. And so here he lists what he's talking about, why, and he may even include a couple of graphs here and there. And so let's thumb through and see what we got here. Economy in 7 steps. Whether it's a book or business presentation, I believe any complex topic can be broken down to between 3 and 7 important pieces. The principle applies to this edition as well. I describe the concepts fast, facts, what you should know and why you should care about it. Common sense, start to finish. Beyond the first chapter, here is how the book is laid out. Chapter 2, economy and cycles. They look at the economy as a whole, as well as its current condition. Chapter 3, money prices. What is money? What it does and what happens to it. Chapter 4, banking. Once we understand money, it's time to learn about banks, the different kind of banks, and how the banking system works. Chapter 5, government and government programs. The basic system outlined who are the big government players in the economy. Economic school and tools. From government and government policy, we take another step toward big picture. What are the major schools of thought for managing or guiding the economy? Chapter 7, finance and financial markets. The first 6 chapters cover the macro world, but what about those things that happen on Wall Street that got us into trouble? Yes, there are hundreds of books about stock market and Wall Street, but do they explain what Wall Street concepts connect to the larger economy? Interesting. So he's going to dive in deep, and then he gets into trade, chapter 8, trade and international economics. What is globalization? How it will affect you? What makes the dollar gain against the euro or vice versa? And so right now we're at, almost at parity with the euro. So this is interesting. But so anyway, the basics, assets. Let's just thumb through here. Talks about the broker, capital, competitive advantage, consumer, credit, debt, elasticity, entrepreneur, forecast, free enterprise, innovation, interest, investor, macroeconomics, microeconomics, monopoly, a single company or individual controlling an entire product or service. In the 19th century, monopolies were fairly common in America, i.e. Standard Oil, throughout the late 19th and 20th centuries. Many of them, which were broken up by legislation, started with the Sherrill Antitrust Act of 1890. Today, government agencies review mergers in an attempt to prevent the formation of monopolies, mortgages, outsourcing, venture capital. All right, economics, economy and economic cycles. Thumb through here. Income, what you should know. Income is what people earn through either direct labor or as a owner of investments. Why you should care. Most of you probably care about your personal finances and that of the nation that is around you. Your own income ultimately determines your purchasing power and is a key factor in your overall quality of life. If your income is increasing, or worse, if it's decreasing, you know that you're not a good thing, and you might as well adjust your lifestyle. Income changes also can be useful at measuring stick for the other economic factors like growth and asset prices. During the real estate boom, for example, some prices far outpaced gains in income. Smart economists knew this couldn't last forever. Either incomes had to rise or home prices had to stabilize or fall. So watching gains in income can be a good test to make sure the economic changes make sense. Interesting. Consumption. Quite simply, consumption is what we in aggregate consume. Why you should care at a national level. During boom years, during the Great Recession, low interest rates, easy credit, and low cost imported goods combined to cause consumption bubble of massive proportions. The Great Recession was in part an unwinding that bubble. Saving rate went down from negative to moderate positivity as consumer became more conservative. So yeah, he's definitely going to hit hard into the Great Recession and how and why. So here we have savings and investment, why you should care, gross domestic product. And then here we have a couple little charts or whatnot, what you should care about the GDP. The breakdown of U.S. GDP components from 2012 is also interesting. Personal consumption, 71%. Personal and business investment, 15%. Public or government consumption, 17%. Exports, 13%. And imports, negative 16%. So yeah, that goes to show our trade deficit right there. Anyway, so he goes through, gives another chart here. U.S. unemployment rates. Shows a nice little trend from 1890 all the way to 2011. So here we have something consistent. And then we have a boom and then a drop off. So I'm not sure. This is the Bureau of Labor Statistics. So a lot of people question their accuracy of their data. So that's interesting there. U.S. recession. So he has a fair amount of graphs and stuff in here. So what I'll do is just scroll through, pull out a couple other things here. The misery index by president. Harry Truman, from 1948 to 1952. Average misery index 7.78. Overall rank was 5. So it looks like he ranks the presidencies over the last couple years. So Harry Truman was 7.78. It has Barack Obama, 2009, the president, at 10.48 at 8th. And so the worst was Jimmy Carter during the inflation time, and the best was Dwight Eisenhower, 6.62. So it looks like the lower the misery index, the better the economy. So right now we're at 10.48, which means that we are near, what could be considered all-time highs, if that's how the misery is graded. It's so interesting. So let me actually find out what the misery index is. Sometimes it helps to put our economic data that you see here and read about together in context with single indicator or tools. It's like taking all the weather data, temperature, humidity, precipitation probability, wind, speed, and coming up with it's going to be a nice day or in case a bad day. Some years ago, Economist Arthur Okun did this for us by creating a misery index. By adding together the inflation rate and the unemployment rate, you arrive at the misery index. So, inflation and unemployment. 10.48 is our current listing as far as the amount of misery that's in the economy, in the United States rather. So, interesting. So he has a fairly amount of detailed information in here, distribution of income and wealth. So yeah, this is definitely a very thorough breakdown of economics. 101 of the most important things worth knowing about. And so here we have historical inflation rate. And so as you can see, it's a fairly consistent, up and down, up and down, up and down, up and down, up and down. But here as of lately, it's been, up drastically against the fight against deflation. So then it gets right into deflation. So yield curve, risk premium, the gold standard. Let's see what he says about that. Are your dollars as good as gold? That's the central question to understanding what a gold standard is and how it works. What should you know? In the gold standard monetary system, paper currency is pegged and convertible into preset fixed quantities of gold. The supply of money is specifically tied to gold reserves held by central banks. The gold standard prevailed during the late 1800s and first half of the 20th century, but gradually subsided starting in the Great Depression and was done away with altogether in 1971 after many years where $35 in paper could be exchanged for an ounce of actual gold. This means that central banks, including the Federal Reserve, effectively had no constraints in terms of expanding and contracting the money supply to affect monetary policy. Then he goes on to say, since no country actively uses the gold standard, those living in fear of hyperinflation buy the metal outright. And that pushed the price of gold up to a recent high of more than $1,900 an ounce, although it has subsided to $1,200 to $1,400 range recently, still high by historical standards. So, why you should care? The gold standard debate is theoretical for most of us, but serves as a reminder that money is simply a commodity, and if there is too much of it, its value goes down. Many investment advisors recommend holding at least some gold in your portfolio as an actual metal or as in commodity futures or gold mining stocks to anchor at least a portion of your wealth to a gold standard. That's up to you, and there are plenty of downsides. But understanding the gold standard can help you think through such an investment. So then he gets into banking, investment banking, central bank, Federal Reserve. If you're a follower of rethinking the dollar, then you're more than aware than a lot of these concepts here. But if you're new to it, these are all things that will definitely be worth your while as far as beginning to really get into understanding these things more. So here we have the target Fed funds rate, 1954 to 2009. And so we have here what would look like an upward trend of interest rates. And now, as of the last, since the Great Recession, we're almost at the very bottom. Can't go much further, except for going into negative. Fed open market operations. So here, this is a very thorough and detailed book on some concepts that is worth knowing and gaining a better understanding of how the economy operates and how it relates to you. So if you're interested, definitely, I would recommend this book highly. It is definitely detailed and very thorough, and it basically gives you a point as to what it's about and why it's important to you. Here we have Obamacare, and that's a big topic of the discussion these days and how it's failing the people. So I'll let you guys read that if you're interested. Other than that, I just wanted to give you a cover-to-cover look of the book. He talks about Austrian Keynesianism. So definitely a worthwhile book if you're interested. I would recommend it highly. So anyway, I want to keep this sweet and simple and short. If you're, enjoy this short summary, give me a thumbs up and also leave me a comment. I would definitely love to hear your thoughts on this book. And if you end up going out investing in it, definitely can learn something. And also, if you want to give it to a family friend, help them explain what's going on in this crazy monetary world we're living in, definitely might be worth it. So other than that, hope all is well. Hope you enjoyed this. Leave me a comment below. Let me know. And if you're new, subscribe to RTD for more of these, inside looks of, some monetary books. Enjoy.